ಬೃಂದಾವನ ಪ್ರಗತಿ ತಂಡದ ಪರವಾಗಿ ನಾನು ಪದ್ಮಿನಿ ಹೇಮಂತ್ ಇವತ್ತಿನ ಟ್ಯಾಕ್ಸ್ ವೆಬಿನಾರ್ಗೆ ತಮ್ಮೆಲ್ಲರಿಗೆ ಸ್ವಾಗತ ಸುಸ್ವಾಗತ ಅಂತ ಹೇಳಕ್ ಬಯಸ್ತಾ ಇದ್ದೀನಿ. ಇವತ್ತು ಟ್ಯಾಕ್ಸ್ ಅಡ್ವೈಸರ್ಸ್ ನಮ್ಮ ಜೊತೆ ಮೈ ಟ್ಯಾಕ್ಸ್ ಫೈಲರ್ ಇಂದ ಟ್ಯಾಕ್ಸ್ ಮ್ಯಾನೇಜರ್ ಅನಿಲ್ ಕುಮಾರ್ ಅವರು ತಮ್ಮೆಲ್ಲರಿಗೆ ಈಗಾಗಲೇ ಪರಿಚಯ ಇರ್ಬೋದು. ಅವ್ರನ್ನ ನಾವು ಬೃಂದಾವನದ ಕಾರ್ಯಕ್ರಮಗಳಲ್ಲಿ ನೋಡಿದೀವಿ. ಈಗಾಗ್ಲೇನೆ ನಮ್ಮ ಎಡಿಸನ್ ನ್ಯೂ ಜೆರ್ಸಿಯಲ್ಲೇ ಇರ್ತಾರೆ. ಸೊ ಅನಿಲ್ ಅವರಿಗೆ ಹಾಗೂ ಅವರ ಜೊತೆ ಪ್ರತ್ಯೇಕವಾಗಿ ನಿಮ್ಮೆಲ್ಲರಿಗೆ ಮಾಹಿತಿ ಕೊಡ್ಲಿಕ್ಕಾಗಿ ಆಲ್ ದ ವೇ ಫ್ರಮ್ ಇಂಡಿಯಾ ಕ್ರಿಸ್ಟಿ ಪಾರ್ಥಿಬನ್ ಅವರು ಜಾಯಿನ್ ಆಗಿದ್ದಾರೆ. So I would like to welcome both Anil and Christy. A very warm welcome to both of you. Thank you so much for taking time out. I know it's a very busy time for the two of you. This is the tax filing season. And all our Brindavana team members, they have many questions during this tax filing season. So I would really want you to address, all the questions that they have in their minds. To give more information and, a little bit of an introduction about both our tax advisors, I would like to welcome Srimati Sarayu Gattu. Sarayu.
Namaskara. Thank you, Padmini Aure. ಎಲ್ರಿಗೂ ನಮಸ್ಕಾರ. ಜನವರಿ ಹೊಸ ವರ್ಷದ ಸಂಭ್ರಮ ತರೋದಲ್ಲದೆ ಅದ್ರ ಜೊತೆ ಟ್ಯಾಕ್ಸ್ ಫೈಲಿಂಗ್ ಆತಂಕಗಳು ನಮಗೆಲ್ಲ ತಿಳಿದ ವಿಷಯವೇ. ನಿಮ್ಮ ಆತಂಕವನ್ನು ಗಮನದಲ್ಲಿಟ್ಕೊಂಡು ಪ್ರಗತಿ ತಂಡದವರು 2020 ಟ್ಯಾಕ್ಸ್ ಫೈಲಿಂಗ್ ಮತ್ತು 2021 ಟ್ಯಾಕ್ಸ್ ಪ್ಲಾನಿಂಗ್ ಈ ವೆಬಿನಾರ್ ನ ಆಯೋಜಿಸಿದೆ. ಇದರಲ್ಲಿ ಭಾಗವಹಿಸಿರುವ ಎಲ್ಲರಿಗೂ ಪ್ರಗತಿ ತಂಡದ ಪರವಾಗಿ ಮತ್ತೊಮ್ಮೆ ಸ್ವಾಗತಿಸುತ್ತೇನೆ. ಈ ವೆಬಿನಾರ್ ನಲ್ಲಿ ಮೈ ಟ್ಯಾಕ್ಸ್ ಫೈಲರ್ ಸಂಸ್ಥೆಯ ಮಿಸ್ಟರ್ ಅನಿಲ್ ಕುಮಾರ್ ಶ್ರೀನಿವಾಸ್ ರೆಡ್ಡಿ ಮತ್ತು ಮಿಸ್ ಕ್ರಿಸ್ಟಿ ಪ್ರತಿಭನ್ ಅವರು ಟ್ಯಾಕ್ಸ್ ಫೈಲಿಂಗ್ ಮತ್ತು ಫೈನಾನ್ಷಿಯಲ್ ಪ್ಲಾನಿಂಗ್ ವಿಷಯಗಳ ಬಗ್ಗೆ ನಮಗೆ ವಿವರವಾಗಿ ತಿಳಿಸ್ಕೊಡ್ತಾರೆ. ಅದಲ್ಲದೆ ವಿಷಯದಲ್ಲಿ ನಿಮಗಿರುವ ಎಲ್ಲಾ ಪ್ರಶ್ನೆಗಳನ್ನು ಉತ್ತರಿಸ್ತಾರೆ ಮತ್ತು ನಿಮ್ಮ ಸಂದೇಹಗಳಿಗೆ ಸೂಕ್ತ ಪರಿಹಾರವನ್ನು ಸೂಚಿಸುತ್ತಾರೆ. ನಿಮ್ಮ ಪ್ರಶ್ನೆ ಮತ್ತು ಸಂದೇಹಗಳನ್ನು ದಯವಿಟ್ಟು ಚಾಟ್ ನಲ್ಲಿ ಮೂಲಕ ನಮಗೆ ಕಳಿಸಿ. ಈ ವೆಬಿನಾರ್ ನಲ್ಲಿ ಕಣ್ಣೇತರರು ಭಾಗವಹಿಸುವುದರಿಂದ ವಿಚಾರ ವಿನಿಮಯ ಇಂಗ್ಲಿಷ್ ನಲ್ಲಿ ಮಾಡಿಕೊಡುತ್ತೇವೆ. Now brief instruction about the speakers. Our first speaker, Mr. Anil Kumar Srinivas Reddy, is a tax manager at My Tax Filer Edison NJ and heads both US individual and business tax filings. Anil Kumar holds a MBA degree from Bangalore University. He joined My Tax Filer in 2009 and was a branch manager in the Bangalore office location. He was shown a lot of interest in growing business, which has led him to lead the office here in Edison NJ since the year 2017. Mr. Anil Kumar is an expert in IRS streamlined filing procedure, IRS audit presentation, and handling the complex tax filings of high net worth clients, tax planning and cross-border taxation, India and USA. Our second speaker, Ms. Christy Pratibhan, EA, is a senior tax manager at My Tax Filer. Ms. Christy joined My Tax Filer team in 2018 after having worked with the leading organizations, including Big Four. Since beginning of her career in 2005, she has been a sought-after professional by her stakeholders because of her work ethics, knowledge, and commitment. Ms. Christy has cleared CA intermediate level with the Institute of Chartered Accountants of India, ICAI, and holds a distance MBA degree from IGNOU, New Delhi. She is an enrolled agent EA admitted to practice before the Internal Revenue Services, IRS. Christy's expertise includes, but not limited to, US tax compliance, IRS audit representation, client complex tax filings of high net worth clients, tax planning, cross-border awareness on several other countries, including UK and India. She also advises clients who have missed to be compliant on the filing foreign bank account reporting forms, FBAR, and report offshore income to enroll under IRS amnesty programs such as Offshore Voluntary Disclosure Program and streamlined filing procedures. She is continuing to involve herself in leading the My Tax Filers India branch office and strives to bring up budding tax professionals in their work ethics to deliver exceptional client service. Now I welcome both Mr. Anil Kumar Reddy and Ms. Christy to start the webinar. Now it's over to Mr. Anil Kumar Reddy.
Thanks, Rayu and Padmini, for your warm welcome, and really appreciate the intro whatever provided. Am I audible, team?
Yes, you are, Anil.
Okay. Fine. Ellargu namaskara. And as you know, myself, Anil Kumar, with My Tax Filer Edison office. I'm a senior tax consultant, and being partnered with Kannada, Brindavana Association all these years, we just wanted to give you our best during the tax time to make sure like you file a compliant tax returns, and we give something best out of our expertise. So, just to shorten and not to waste the time, like I'll just quickly jump onto the topics today, what we are going to talk, and we just give a quick intro on what we are. So see, we My Tax Filer started in the year 2008, and now on, like we have, 3 verticals in the My Tax Filer now, which is My Startup CFO, and Sudhir Pai CPA PLLC, and Legacy Wealth Planners. It's purely into wealth management. I have listed on the list of services provided by My Tax Filer on the left-hand side. If you see, like we provide the services like tax preparation for both individual and business. We provide all the services for the business from formation till dissolution, like whatever the services required, like say bookkeeping, payroll, tax resolutions, or particularly on the international compliance, we do provide the India tax filing, applying PAN card for the NRIs like living here, and people who have not received their social security numbers and eligible to, in order to get onto the tax return, they need some tax ID number, which is called ITIN preparations. Yes, we are the registered, authorized agents from IRS. We certify, the applicants to get the ITIN applications, and we help them out get the ITIN numbers assigned by the IRS. And we also are expertise on IRS amnesty programs, on the cross-country taxation or cross-country international compliances, particularly on streamlined filing program or overseas voluntary disclosure program, which was earlier there till 2018. Yes, we are expertise on inheritance and repatriation aspects too. And talking about the My Startup CFO vertical, it's purely into funding assistance and outsourcing finance and accounting. Sudhir Pai CPA PLLC is into advisory and audit and assurance. And we have the new wing added to My Tax Filer, that is Legacy Wealth Planners. It's purely into retirement planning, estate tax planning, and risk management, as well as investment planning. So, just a disclaimer here, like all this guidance included in this webinar is to share the knowledge on US tax and compliance requirements. It's not a legal or tax advice, and it's not basically a sales pitch. It's purely an education given to all our Brindavana team here, or the family what we are here. Examples of tax benefits are based on the state IRS guidance and assumptions as of today. And it's, you better do your due diligence as well. But we are always there. You can always reach out to New Jersey at My Tax Filer for any of your professional services required. And what we are going to talk today, and the agenda here, we are primarily talking on filing due dates for the year 2020. What are the tax rates changes compared to 2019? And what does it mean? How is a person treated as a resident in case if he has entered for the first time to United States? And new updates for the tax year 2020, as you know, because of COVID, there are multiple changes, as well as, good amount of provisions provided by IRS too. I just wanted to stress a couple of things, which will be, very much related to every person living here in US when filing their tax returns. And I would like also to talk about the other deductions and credits, the couple of changes, whatever happened for the year 2020. And then going forward, like all the compliance, like international disclosures, or it might be international compliance requirements on the investments what you have back in India. And Christy will continue so on and so forth on tax planning and some wealth management stuff here. So basically here are the due dates for filing the tax returns. Like for 2020 tax year, the C corporation and personal tax return due date would be April 15, 2021. And as you know, like every year, IRS used to start the tax filing by first week of Jan, last week of Jan. Sometime around like 27th or so. Like this year, even though they announced they are going to start from 27th of January, for some reason, because of systems being updated or the new provisions and multiple adjustments on their system, they started filing the returns with accepting the tax returns only from 12th of Feb 2021. Having that said, it's not that like they're going to extend the tax deadline from April 15 to further. They don't have any clue as of now, but we urge everyone to file the tax returns within the tax deadline to make sure you're compliant and get the refunds within time. And particularly on the partnership or S corporation tax returns, the filing due date is March 15th, 1 month prior to the personal as well as C corporation tax returns. And for all the non-profit tax returns, the due date is May 15, 2021. And in order to pay any estimated taxes for the year 2021, it will be, the first quarter, the first installment due date is 15th April 2021. That is whatever you make in the first initial 3 months of the first quarter in 2021. You have to pay the estimated taxes before 15th of April to avoid any additional interest and penalties being charged at the end. And here are other, due dates, like probably, hope you might have heard about like Paycheck Protection Program here. There was initial Paycheck Protection Program, which was already, initiated in the year 2020 in the month of April, and people might have enjoyed in case if they're eligible, having payroll run with their organizations or self-employed or being, sole proprietor there. Now, there is also a second round of Paycheck Protection Program, which is still open. And the due date to apply for this Paycheck Protection Program, that is the second draw, will be March 31st, 2021. And provided, the businesses, if they're eligible, they will be eligible to claim up to, apply up to 2 million of, loan amount. And later it will be forgiven. It's a forgivable loan, which provide, in fact, like you just have to prove it, saying that it's purely used for the payroll purpose and the options, whatever given by IRS. And here is a new additional thing, like which we have, which is something and hot topic everywhere. Like every client calls us and asks, like in case saying that like this person who is making, like if they're filing a joint tax return, they call up and say, but Anil, say we have not received the stimulus pay for the first round. Say IRS has already, issued both rounds, like the first and second round of economic impact payments. People who have not received, and in case if they're married filing jointly and have income less than $150,000, yes, having an SSN, you will be eligible to get the stimulus pay. Even though if you are not received in the first round, please talk to us and we can help you get the second round of stimulus payment, first round of stimulus payment, along with your tax returns when we file the tax returns. And applying emergency grants, like yes, you are eligible to apply. There are businesses which, in case if they're eligible, they can apply and loan up to 2 million. And the due date to apply for this loan amount is December 31st, 2021. And in case if there is already a loan applied and from the first PPP, make sure like the forgiveness has to be filed within 10 months from the date it was granted. Talking about the estimated taxes, yes, like it's good that it's a good practice. Like if a person is working on some 1099 apart from a W2 or having some other passive incomes where you usually don't have any estimated taxes paid, yes, we recommend you to pay the estimated taxes within the 15th day of the following month of the quarter. That would be like 15th day of 4th month and 6th month and 9th month. Usually to make sure you're compliant and not being charged with any additional penalties for future dates. And obvious, apart from the calendar year tax years, calendar year tax returns, in case if the business is a fiscal year tax returns, yes, the due date will be following 3.5 month to pay that estimated tax dues. And obviously, the state estimated tax payment differ for each state, like but more or less it will be same as the federal for majority of the states. And the reason we stress on this to make sure you avoid costly underpayment tax penalties, because we have seen multiple times claim coming to us like end of the year saying, say when we talk about when we start calculating this tax penalties, like tax dues, it'll also attract huge amount of penalties and interest because of not paying the estimated taxes upfront. Particularly, say both husband and wife are being employed and the W4 form what they submit to their employer is not properly filled out, or they have some 1099 incomes which are which usually will not have some upfront taxes withheld. Those kind of areas we ourselves, like it's a pain for the client too, just to shell out a huge amount of penalties and interest which will be calculated day one from the every quarter wherever you have missed out. Moving on to the next slide, like these are all the tax rates for 2020. There is slight relief when compared to 2019 in the tax bracket, when increase of $10,000–15,000 in the higher tax bracket and around like $3,000, $4,000 in every tax bracket when compared to 2019. We are not sure like what's it going to be, what are the tax brackets going to be in the future days, as it's a new administration now with Biden. Majority keep talking about the proposal saying going back to the regime what we had prior to 2018 before we had Trump administration in effect, where the tax bracket again might go up to 39.6% from 37% of tax bracket what we have. So capital gains are being taxed at just to give an high level here, like we have basically see majority of the tax filers by file either single or married, and in worst case like we see married filing separately, and in case we see head of household filing status. So basically you're taxed on the tax brackets. It's a constructive tax rate, it's not a flat tax rate what you're being charged. And we are just projected here what is the state, what is the state level taxes on all the 50 states back here, and out of which a couple are tax-free states. But as you know, California, New Jersey, New York, or all these states, or whichever, these states are particularly high tax rate. So better you plan your taxes, talk to a consultant, that way you reduce your taxes too. And the standard deduction compared to last year, yes, it has been increased by $200 per person. So 2019, the standard deduction for filing a single person was $12,200, but now it is $12,400. And filing a joint tax return, the standard deduction is $24,800, which was $24,400 in 2019. And the capital gain taxes, yes, the short-term capital gain will just attract, say, the regular tax bracket where you fall under based on the constructive tax rate and the merit and the filing status with what you opt. But particularly on the long-term capital gain, say if you're holding that stock for more than a year or a fund for more than a year and selling the fund after a year, which is treated as long-term, those are not charged with, even though if a person is under 37% tax bracket, he is just charged with 20% taxes plus additional investment taxes or whatever to be charged. So it varies based on the income and the tax bracket what you fall under, but the max tax cap for a capital gain, long-term capital gain would be 20%, nothing beyond that. And here is the high level, picture I just wanted to give you, like, what are the tax obligations, particularly for a citizen, green card holder, or a resident, and what is that, a non-resident has to consider. Say there are two things which we have to see here. One is if you're a citizen, green card holder, or a resident, say for example, a person has come here on a work permit like L1, H1. So if he's residing here in this United States for more than 6 months, or that is more than 183 days in the tax year, yes, he's treated as a resident of that resident of United States. Then having tax home in US, this is where we talk more with our clients, and many literally were not aware in the past because of not having sufficient guidance or just filing it online through some tax tool, where the tax tool will not obviously not give any of much information, rather it just keep accepting the numbers what you put. Else like the taxpayer has to spend good amount of time educating himself, like what is that a resident has to be compliant on. I just want to stress here, like say, once you're a citizen or a green card holder or a resident of United States and having a tax home in US, that is a resident of US, right? Like it's an obligation for you to report the worldwide income. So it doesn't matter whether you're paying taxes in India on the same income. For example, majority sitting here, yes, we might be having assets back in India, or foreign financial accounts back in India, or some kind of passive income generated back in India. Say it doesn't mean that like, IRS always expect, not only United States, yes, even the Indian government, they expect you to report the worldwide income once you become a resident of India. Same way United States is expecting you to report the worldwide income. At the same time, if you're paying any taxes to the foreign country and reporting the same amount of income here in United States being a resident, you can always claim the foreign tax credit to avoid double taxation. And yes, even though if you're adding this foreign income to your 1040 tax returns, still the progressive tax rate apply, and the credit is allowed to the extent whatever paid in India and based on the ratio whatever applicable as per IRS norms. And there are other set of clients, like say where people, being a taxpayer, a green card citizen, green card holder, or a citizen, settled back in, anywhere outside of United States, he is still obligated to report the worldwide income to United States because he's a GC holder or is a citizen of United States. And he will have an exclusion of $107,600, initial exclusion on any of his active income, like say it might be compensation or business income, and but it's an obligation for him to report the worldwide income again to US government. And talking about the US source income for a non-resident, I mean, I just don't want to take much of time on this non-resident because not many here are really applicable, really fall under this particular category. Non-resident, when you're a non-resident, basically when he is on a visa and he's outside of United States for more than 6 months, or I mean he does not qualify as a resident, then he'll just file the tax returns. Or let's say a person entered United States for the first time and he stayed here for less than 6 months, then yes, he's a non-resident, and there is no requirement of he reporting any of the foreign income to United States. He just file his US income, whatever earned the W2 or whatever income made here, he'll just file the tax returns to United States, and I mean he'll get out of it. There is no obligation for him to report any worldwide income to United States. So here are the elections what we recommend for a person who is a first-time visitor to United States. Say if the person has first, let's say even he's a married guy and the taxpayer has entered United States for the first time, and he has not accompanied his wife along with him to United States in the first visit. There is an option, because as you know, I mean, filing separate or filing jointly, compared to filing separate or single, married filing jointly will give more amount of tax benefit, or the tax brackets are very much liberal when compared to married filing, when compared to single or married filing separately. We recommend, like if there are any listeners like who have come for the first time to United States, and if their family is back in India and they are not joined them, there are still possibilities where we can file a joint tax return, take the advantage of married filing jointly tax brackets, and also get the double standard deduction for both husband and wife. But this is a complete rule box. I mean, as per the IRS rule box, we have an section called section 6013G. We can go ahead, apply that particular rule and take the advantage of saving the taxes. And such kind of elections, or the person living abroad, they may obviously require an IT number to apply. Yes, we'll help them out to get the IT number assigned and file a joint tax return. So here are the new updates for the tax year 2020. So economic impact payment and recovery rebate credit. So, I mean, this is something related to the stimulus payment. The IRS has already issued all the first and second round of stimulus payments. If you did not get any economic stimulus payments, or you received less, got less in the year 2019, you can, let's say your income was reduced in the year 2020, you can go ahead and file the 2020 tax returns, claim the differential and take the advantage. And also you can talk to us, let's say if there is an increase in income in 2020, as you know, people are expecting the third round of stimulus with $1,400, whatever being discussed, and each kid, I mean, these are the line items which are there in the additional stimulus for third stimulus. Say if the kid is less than 6 years old, and I mean, there is a discussion going on like where a kid will be given with $300 per month, which is around $3,600 per annum, apart from the $1,400 of stimulus pay, whatever being sent out to eligible taxpayers, both husband and wife. And yes, if you're not received, you're eligible to claim it in the tax year 2020 when filing your tax returns, provided you meet the income limits. And there's one more new update coming, which has been released for the year 2020. Probably like election for better ACTC. ACTC stands for Additional Child Tax Credit and Earned Income Credit. It means if your earned income was higher in the year 2020 and was higher in the year the income was higher in the year 2019 and was lesser in 2020, you can always use that as a substitute income to make sure you take the benefit of Additional Child Tax Credit and EIC. And there's one more new update, like majority you might have seen, like charitable donations you make to some 501c approved charities. Say for example, like all these years, if a person file an itemized tax returns, only then he was eligible to claim this charitable donations what he make. Let's say you're filing, let me give an example, a simple example. Let's assume you're filing a married filing joint tax return and you get a standard deduction of $24,800. And let's say you made a charitable donation of $500. It would have just got drained and you would have not made use of that, because many places you talk like, right, like the organization where the money, they get the money, they tell, yes, this is a receipt, you go ahead and claim the tax benefit, you are allowed to deduct the taxes. but this was possible only when the itemized expenses, the charitable donations or some medical expense, all these exceeding the standard deduction amount of $24,800 filing a joint tax return. But for the year 2020, there is a new update where you can claim and separate line item of $300 up to $300, like nothing beyond that. Even though if you have contributed $1,000, you are allowed to deduct $300 from your gross income. I mean, on the charities, whatever you have, I mean, charitable donations, what you have made, even though you do not itemize your tax returns, even though if you're going with the standard deduction. And there's one other benefit with the FSA benefit, like say all these years, like, I mean, this is something like flexible saving account, like you get through your employer, and say for example, if you're not made use of that particular amount in the year 2020, then you can, because of pandemic, many were not sent to daycare center, and I mean, you know that it becomes a taxable income because it's all pre-tax money being deposited to this account. You can just, I mean, postpone this to the coming year, and we can discuss more on this. This is something vast, like we can talk over this. I mean, if people have question, and they can reach out to me. And the other new line item on 2020 tax year is deductible IRA contributions for taxpayers above age 70 and a half. So all these years, like people with 70 and a half years, till 2019, there was, I mean, there is restriction like where they can't go ahead and contribute something to IRA. From 2019 on, if you are 70, I mean, if a taxpayer is beyond 70 and a half year or older, he can still go ahead and contribute something to Roth IRA and roll it over to traditional IRA. And one other, I mean, sick and family leave credit for self-employed, like say if this is one new line item added for 2020 to claim the credit. Like for example, if any of the sole proprietor, a self-employed person, like a single member LLC kind of, if he or somebody in their family is hit by COVID, with the complete documentation provided, whatever the sick and family leave paid can be claimed as a complete credit on their tax returns, which will save huge amount of taxes. And these are all the basics deductions and credits what we regularly see. One is the traditional IRA, where you can contribute. I mean, if your age less than 50 years old, like you contribute. I mean, $6,000 for traditional IRA within the tax due date, because this is all pre-tax money. And if you're beyond 50, like you have additional catch-up, where you can, I mean, you can add up additional $1,000 to that $5,000 of contribution what you make, and this can be done anytime before April 15th of 2021. That can be treated as a deduction for the year 2020 tax returns. SEPA IRA, as you know, it's an employer contribution, and even all the self-employed people, like they can park up to like $57,000 to serve SEPA IRA, provided they're eligible. And the simple is also kind of IRA what we, it's all in retirement planning what you do. And HSA personal contribution, yes, this is big. These two we are stressing more because like particularly the traditional IRA and the HSA, because even though the calendar year has already passed, you still have an option to go ahead and contribute to traditional IRA, which is a pre-tax money. You can claim the deduction on your tax returns. And let's say it's in a HSA, that is health saving account. Yes, you can still go ahead and, even though the calendar year has already passed for 2020, you can still go ahead and park HSA, amount to HSA up to $7,100 if you're filing jointly. And that's all pre-tax money. The only thing is like you have to make sure this amount is used purely for medical purpose. That way there is no, tax implied when there is a distribution taken out of that particular account. And yes, we see a lot of questions like, because, having huge amount of medical expenses, they usually question us. Is there a possibility where we can claim the medical expenses as part of our taxes that will at least save some money for us? Yes, it's part of itemized deductions, but provided your out-of-pocket medical expenses are beyond 7.5% of your gross income. If it's not going, if your out-of-pocket medical expenses are not going beyond 7.5% of your adjusted gross income, then literally it does not make any sense. You spending much of time amount on it. And any property taxes, state and real estate taxes paid, state and local taxes paid, yes, you are allowed to deduct all these property tax and state and local taxes. But as you know, from 2018, with the new reforms introduced, there is a cap of $10,000, even though the person pay $50,000 of state taxes and $30,000 of property taxes. The max allowed deduction on your itemization would be only $10,000. We usually call this as SALT, SALT, state and local taxes. There is no cap on this mortgage interest, particularly, I mean, unless the worth of the property is more than a million or so. If not, yes, whatever the mortgage interest you pay on your primary property or the vacation home, you are still allowed to deduct the mortgage interest as part of your itemized deductions. And any investment interest you are charged on the trading account, particularly. Let's say you have a brokerage account and you borrow money to trade your regular transactions of the day trader kind of. Yes, the interest being charged on that particular loan borrowed from the financial institution is still allowed as a deduction as part of your itemized deductions. And I already talked about your charitable donations. The only beauty, the big change happened in 2020 versus any other tax years, particularly on the charitable donations. All these years, even though it was a cash contribution, cash donation made to any of the 501c approved charities, you were allowed to deduct, let's say till 2018, it was only 50% of your gross income. Or in 2019, it was 60% of your gross income. But this year, they say you can deduct your charitable donations up to 100% of your gross income. Say a person has made a charitable donation of $50,000, like, and his income is, $80,000. There's no restriction as 50 or 60. He can still go ahead and deduct $50,000 as charitable donations made, and he can save the taxes on it. And here are some other, basic deductions what we talked about, like child and dependent, child and dependent care credit and child tax credit. Usually, child tax credit is given for, people who are filing a joint tax return or head of household, and say filing a joint tax return. If your overall income is less than $400,000, yes, and you have a kid less than 17 years old, and having an SSN, each kid get $2,000 of child tax credit. And say if your child is being sent for a daycare center or after school or Montessori, you still get $600 of a dependent care credit, provided both husband and wife are being employed. And this particular line item, like American Opportunity Credit and Lifetime Learning Credit, yes, we see a lot because many here probably who are listening here, you might have your son or daughter going to undergrad. They're doing their undergraduation or masters. And usually you will have huge amount of tuition and tuition fee expenses incurred, which might be around $50,000 or $40,000 paying per annum to the institutions. And there are possibilities like where you will be eligible for American Opportunity Credit. Like say this opportunity credit is given for kids, particularly, the dependents who are particularly pursuing their post-secondary, that is the first 4 years of their undergrad. And provided, let's say you are claiming your son on the tax returns and your income is less than $180,000, you will get a credit of $2,500. That $2,500 is not a deduction, it's a credit where it will reduce your taxes to the extent of $2,500. And lifetime learning credit is something even you might be eligible. Let's say you are, currently working and you have some, additional value-added courses, value-added stuff added to your regular profession, and you have some educational expenses incurred. You will be eligible to claim up to $2,000 of lifetime learning credit, provided you meet the income limit or threshold limits being, you're not exceeding the threshold limits of income, whatever specified by IRS. And talking about the energy efficient credits, yes, this is something like you have a primary home and you have some solar panels installed on that home. In the year you have installed, you get, say 30% of that cost as credit on your tax returns. Let's say you had $20,000 of expenses incurred on solar panels, and you installed in the year 2020. Yes, if you have done that for your primary property, you are eligible to get 30% of it. Like say $6,000 is given as a credit on your tax returns. Make sure like you address all those stuffs in case, in case if you have installed any in the year 2020. Earned income credit, like not many might be eligible here, but still I just want to stress, just throw some light on it. Like provided, having two dependents and being, having lesser income around say around $45,000 or $55,000, something like that. Like you get some earned income credit, which from both federal and state tax department, but not really everyone here might be eligible for this because the income has to be really literally low with one, two, three dependents to get eligible for this. foreign tax credit, this is purely like already talked about, like say if you are reporting some being a resident here or being, end of the day, when I say resident, it's all a green card holder, a citizen, or a person on a visa staying here. Say for example, if you're reporting your rental income, whatever earned in India, to the United States being a resident, and you have paid some taxes already to the foreign country on that rental income, you are allowed to claim the credit here to avoid double taxation. Not only rental income, any kind of passive income you make or any kind of active income you make. And premium tax credit, this is something like this is designed for eligible individuals and families with low or moderate income to get the affordable health insurance. And in case if they don't meet that, they can claim the refund the credit back. And quickly, I just wanted to talk on the main topic here, like which I keep talking to many who walk in or whom I really talk new. Say international disclosure, because every person here, like obvious, will have some foreign account maintained back in India. Either it might be for their regular maintenance for their parents back in India, or for their maintenance when they travel there, or some old PF accounts which left out with their employers in the past, or some PPF accounts and life insurance mutual funds, all this stuff. So basically, FBAR is something like foreign bank account reporting, where every resident is obligated to report this particular FBAR in case if the taxpayer has a signature authority in the foreign account and that foreign account values is exceeding beyond $10,000 at any given point of time in the financial year. And it does not mean that if one account does not exceed, you should not file it on the other account. It's an aggregate of all the accounts. Like say one account has more than $10,000 and all other accounts are dormant, doesn't matter. You still have to file FBAR for all your foreign financial accounts. Let's say if one account has 5,000, the other account has 3, and the other account has 2,000. If you aggregate all the values and it is exceeding beyond $10,000, you will have to file FBAR for all your financial accounts. And I want to be clear on it. It's not something, a tax what you pay on the balances, what you maintain in the foreign country. It's all a reporting obligation. You have to report all the balances to US government, whatever maintained outside of United States. This makes your life easy when you want to repatriate money. Say it might be an inheritance money sitting there, or your old money sitting there, or some money being gifted by your in-laws, whatever kind of stuff it is. As long as you report it to IRS, and moving that money in the future will not be an hassle. If not, we don't have a probability, but there are lots of questions being raised by IRS. And this is applicable for both individual and businesses. And this is not something new. This was all started in 1970 itself, and it's also all part of Banking Secrecy Act. And not only, let me give you some light on it. Like it's not just say something US is expecting. Even Indian government has it. Like Indian government expect every resident to report their foreign accounts, and every account, resident to file their FATCA, like Foreign Account Tax Compliance Act. See, FBAR is something where you are obligated in case if you hit $10,000 of limit, any point of the time in the financial year, and this is something additional like the FATCA. We file a form called 8938, which is called Foreign Accounting Tax Compliance Act. Say if you're residing in the United States and you're filing a joint tax return, if your aggregate maximum values of all your foreign financial accounts are exceeding beyond $150,000 or $100,000 by end of the financial year, then you will have to file a FATCA along with your tax returns, where you'll have to file a separate form for each and every account and report it to IRS. All this is to be transparent, and because now that countries are trying to be transparent between the NRI transactions and the funds being transferred across borders, we recommend you to be compliant with reporting all this, because it's all a reporting. It's not you being taxed on it unless you make some income out of that particular money. And the penalties, nothing to scare here. Like it's all purely on the IRS website. If you go read on IRS website, it's more and more, where they talk in detail like what is the penalty being charged for a person in case if he is not compliant filing any of these foreign disclosures. And having said, in case if there is any non-compliance happened in the past, we recommend at least you start from this year. And if a taxpayer want to come out clean, before, I mean, somebody being questioned or some huge funds being transferred between the countries. There is a program called, Streamline Filing Program, where IRS expects you to file the latest 6 years of FBAR and pay some, 5% of penalty for 1 year, whichever the year you have highest year-end balance, and amend your latest 3 years of tax returns, report unreported income to government. You can come out clean. But only thing here is in this streamline filing program, there is no closing agreement being provided by the agents who are being assigned to your particular case from IRS streamline filing program department. So, any taxpayer who is not compliant in the past and want to know more about FBAR, yes, please write to New Jersey at MyTaxFiler or talk to me or raise any questions after our sessions. We are happy to discuss on it. And with this, I just pass it on to Christy, who will be talking more on international compliance or recovery rebate credit and other tax planning stuff. Over to you, Christy.
Thank you so much, Anil. Thank you first to every organizer of this event, and specifically this is tax time, and you would have a lot of questions. So we are there to help you out today. Anil had in fact covered quite a lot specifically on the stimulus. So I will not talk more on the recovery rebate credit. I'll quickly go through and then I'll get to the other important things that you really need to know. So coming to the recovery rebate credit, this is nothing but the stimulus payments that you may have received. Some of you may not have, and that is why this particular credit is applicable for filing in your tax return. So let's say you got your second stimulus only and not your first stimulus, we can help you get it. Now, let's say your spouse has an ITIN. You would not have received your first stimulus payment. On the second issue, that is when the government basically changed, saying that even if spouse has ITIN, then at least the ones that have an SSN would end up getting the stimulus, which is the reason you would have seen a second stimulus, but not the first one. But that doesn't mean that you're not eligible for the first one. So go ahead and claim that through your tax return, reach out to us and we'll be able to fill those particular worksheets that the IRS has given. And then let's say you are eligible, we'll definitely be able to get that to you. One additional note is, let's say you are not filing the tax return on time, or even if you filed early, with the recovery rebate claim, there are more chances that the IRS may delay the refunds, but considering that they have to reconcile your prior year tax returns, etc. So if at all your return has a recovery rebate, so a quick note there that your refunds may be delayed, but you will end up getting them. Again, the filing statuses and what your phase out limits are mentioned there. So I'm not going to cover. Basically, less than a 200,000 for a joint tax return filer, you will be able to claim this recovery rebate credit or the stimulus. Let's move on, Anil. So on the international disclosure side, the FBAR and the FATCA are the very important ones, which Anil had stressed upon again on this presentation. It's important for you to know that the international disclosures doesn't end there. Let's say you're compliant with your FBAR and your FATCA, it's not yet done. Because now that you're resident citizens or the green card holders in the US wants to know pretty much everything that you do in your home country and what ties you have there. So that's the reason they come up with these additional form called 5471, 8865, 8858. These are complex topics, but I would like to keep it very simple to make you understand when you need to reach out to us. So the first thing, let's say you have a private limited company in India where you have some shareholding, and let's say it's more than 10%. So that way, you enter into this additional reporting requirement. The IRS would want to know what's your percentage of shareholding. Are there any other US shareholders as well who end up having a shareholding in that India company, etc. So if that is the case, they would want to know all of those details filled in this 5471. And if you have more than 50% ownership, let's say, you are subject to additional taxes, which is called GILTI. That's a completely different topic in all, which is not in the scope of today's webinar. If you think you have such percentage shareholdings in your foreign country or India or any other countries for that matter, which is non-US, then please get in touch with us. And even if it's a small partnership that you have in India and you have a shareholding or a partnership agreement where you are a 50% partner or a 30% partner, even there you have additional requirements. And let's say both of that you don't have a private limited company or you don't have shareholding in a partnership firm. It's enough if you just have a small business which is registered in India to put you into compliance. You'll have to report the business income, and additional check the box elections need to be made. So watch out if you have anything apart from your, like, let's say interest, dividends, if you have any business source of income in a foreign country. Okay, so on the FBAR and the FATCA, you end up disclosing not only your bank accounts, you end up also disclosing any mutual funds or life insurance policies or bonds, etc., that you have in India. In specific to mutual funds, let's say you have one, the US doesn't want only the FBAR to have that reporting. They want additional forms to be filled where you have to tell them that I had so many units in this particular fund. Let's say Axis Fund, I had 500 units. I purchased so many, and at the end of the year, I had so much, which was valued at, let's say, 5 lakhs or 6 lakhs. And if you had received dividends, or if you have, let's say, disposed some units, there is a tax event. And the tax event, now it doesn't end there as well, because they'd want you to figure out what is the date that you bought the particular fund. And from that day, they would tell you that you did not pay tax to us in the earlier years, but you only paid it on disposition. So let me go back and see what is the share or the profit pro rata for an earlier year. And then they will end up charging you tax at the top rate, which is 37%, right? And on that, they would also charge you interest. So the complications would arise if you have a mutual fund, and with specific elections such as the mark-to-market election, where you could show them the difference in the value of the NAVs, right? And you show it on every year tax return. This would save much of a hassle and a lot of outflow when you ultimately save or sell the fund. So if you have mutual funds, please get in touch, because we'll need to see which election really works out for you so that you have the minimal tax impact. Even Unit-linked insurance plan is also a mutual fund. Let me tell you that, because it is market linked. And if you have ownership, again, in a foreign partnership corporation, there are specific forms, which I already told you. Let's move on to the gifts. Let's say you received gift from your mother or father, inheritance of property, or let's say even cash that is moved from their account to your account in the US. Additional disclosures come in if you receive more than $100,000 in a particular year from a non-resident alien, which is to the US, and then you get it yourself in the US, right? And you are a US person, you will have this requirement. And let's say you get it from a foreign corporation. In that case, it's not 100,000 there. You'll only have to cross 16,600 if you want to get into this reporting. Let me say that this is a reporting form. There won't be any tax. However, non-compliance can lead to serious penalties. We have a client who basically is ending up getting through this whole thing and trying to get into compliance, because she's on an EB-5 and then she's trying to get compliant so that there won't be any issues on the immigration side as well. And let's say you gifted somebody. In that case, again, if it's more than $15,000 per person, then you will have to report that in a particular form called 709. If you're a US resident, citizen, or a green card holder, the limits will be different. And depending on what your annual exclusion amount is, that's the first stage you need to cross. And then we need to see your lifetime exclusion and find out what really ends up getting taxed or not taxed. But in most of the cases, I could say that there won't be tax, but it is going to eat up something called a lifetime exclusion that is given to you, which is 11.58 million for 2020. And the last one I've covered, again, I don't want to go through. Let's move on, Anil. Okay, so this is another topic that we wanted to bring up, because there are many clients there are basically two stages of clients, or two different types of clients. One, they would ignore basically whatever IRS notices come through, or there is another set where they got an IRS notice or a letter and they freak out completely and they want to do something. So in both cases is definitely not good for you. So if you received an IRS notice, do not ignore, because it is very, very important that you correspond with the IRS and respond to all their queries. And if you don't meet the deadlines, that is where the notices get to next stages, where it can either lead to wage garnishment as well, which you don't really like. And at the same time, if you panic again, it's not going to help you in any way. And if you think that the documentation that the IRS needs cannot be produced so simple because you need a lot of work involved there, you could always call up the authorities and then buy time. And that's where we help, because we basically deal with all penalty waivers. Because if you think of, let's say, only $1,000, let me go ahead and pay. If you had come to us and then we represented you, you wouldn't have had to pay the $1,000. So even if it's a small outflow, definitely it's something that you would want to save it for something else. So penalty waivers, we take care. And then if you have any examination on and then you don't know specifically how to respond, we would know it best because we've done it for ages. And then as an enrolled agent, we can represent you on your behalf to the authorities as well. Sometimes you can receive a different tax calculation, because when the IRS looks at your data and then their data in the system and they try to compare, and if there is a discrepancy, they would end up sending you a proposed tax notice. This again, some they may be wrong, some they may be right. So it's important that we analyze the notice completely, see your filing, see your documents, and come up with our suggestions as to what really is the right thing. And that way we could write a specific response to the IRS and get them to agree. If they don't, we could call them and then tell them the situation. And most of the times we've seen that we are able to get the notices closed 98%. Only at 2%, the clients end up having to pay some money. So don't try to do it yourself. Get in touch with us if you would want to keep your notices closed or you want to save some tax dollars. All right. So this is something important that I wanted to discuss now that we are already talking about 2020 taxes, and next we are going to soon touch 2021, where there are many chances that that Biden may come in and then change all the tax rates. He's already put out a proposal and we've tried to compare that in this presentation today. So let's say Biden hurries this up. There are more chances that it can apply in 2021 itself. But let's say that doesn't happen, then the comparison that I'm talking about, you would start seeing from tax year 2022. But let me tell you, it doesn't look good as it stands, because as you see, the first point itself, the income tax rates. So from 37%, the top rate is going to go to 39.6% for any of you who's earning more than 400,000. So high income earners is the target, I'd say here, because there are many other corrections as well if you look at it on the social security taxes, because currently up to 137K, you pay some social security through your employer, and then you don't really pay anything more, even though your income is $1 million. But now above $400,000, they are going to levy additional social security taxes. This is not good news. Capital gains is the worst hit, I'd say, because currently the top rate is 20%. And then with, of course, the net investment income tax, an additional 3.8% gets levied. So totally you end up having to pay 23.8 if your income was more than, like, let's say $550,000. But that is going to go way up to 39.6 if your total income is going to cross $1 million. And with the NIIT, as you can see, 43.4% is the number. It is definitely scary. However, we have many tax planning ideas which you should proactively do so that you don't end up into such baskets. And I would not cover something that is not really understandable on this webinar. But yes, if you have any AMT related queries, then get in touch with us, or something about carried interest. If you're a financial advisor, then please get in touch with us. And itemized deductions is something that you were taking advantage of if you have, like, let's say, mortgage interest, real estate taxes, etc. But again, there was no cap. Now there's a cap of 28%. This is again not really good if you are claiming actual deductions. So that you would get to know when you end up filing the taxes. Let's move on, Anil. On the business side now, given the scope of this presentation and the viewers, I will not talk much here, but in a generic view, let me say that even businesses are getting hit, because the corporate tax rates, it was 21%, and there's something called minimum tax, which was repealed. Now they're trying to bring that up, bring that back, and the tax rates also is going to go from 21 to 28%. There's a business income deduction. If you have any business, you were able to claim 20%, but that again is subject to additional phase outs going forward. And depreciation, again, we had really good depreciation methods if you had bought properties or if any equipments for your businesses. But then again, now they're trying to repeal the act, which means that the depreciation percentage is going to be much lower, and you need more number of years to basically remove the cost that you have invested in through your tax return. Like-kind exchanges is another big blow, where specifically for real estate investors, because they are trying to end this so that there is no tax-free exchange anymore, and you end up having to pay capital gains tax on it. GILTI, which links to what I spoke on the foreign corporations, right? If you have more than 50% shareholding in a foreign corporation, there's something called GILTI that you end up having to pay. It was 10.5%, which they are planning to double to 21%. So as it looks definitely scary, specifically for high income earners. But that's where tax professionals come into play, because if you analyze your complete tax situation with us, and then we see what your income is and what your opportunities are, we can get into a fruitful discussion where we can help you proactively save taxes for a later year, or even when you file the tax return and we see you have a lot of capital gains, we have great ideas to help you defer it. Let's move on. Okay, so this is estate and gift tax. Basically, transfer tax also links to the same thing. The basis basically of the lifetime exclusion, which I told you about, it was standing at 11.58 million with Trump, and then it's even going to go down to 3.5 million is what we're hearing when Biden is going to put in place his tax schemes. So watch out if you want to do any transfers where you have a lot of money, then try to do it quickly before the law really changes. And estate planning is inevitable here if you have good amount of assets in the US. So estate planning as well we help with. You can get in touch with us and we can help you out. Transfer tax rates, again, 40 to 45, and the 45 is not far enough to hit. It hits at a really low income level itself. So this is again something that we really need to worry about at this time. Move on, Anil. Okay, so now that I scared you all a little bit, as I said, we also have ways to recover. The tax rules get complicated and the tax percentages also get higher. However, we have age-old methods versus methods that really came into play with the changes or in the current situation, right? So you could try and take certain things so that you don't really end up falling into the trap and you pay more taxes. So we can help you maximize the deductions, and then you can do a lot of retirement planning. Like if you have a 401k, then you end up only paying 90,500. But let's say you have a defined benefit plan, you can contribute even like 100,000 and defer it from your income. So there are a particular strict rules basically you need to follow. But if you end up following that and creating one, your wages that end up getting taxed in your return is really, really low, and you contribute more to your retirement. So these are good ways you could end up trying to lower your tax dollars right now. And the Tax Cuts and Jobs Act, the FFCRA Act, the CARES Act, etc., have come up with really good benefits. So specifically with the CARES Act, now, there's something called this 401k, which you may have ended up withdrawing because you wanted money. So if at all, there are specific conditions basically that you need to meet. And if you met them, up to $100,000 of your distribution, you don't really have to pay early distribution tax of 10%. And in addition, you need not pay the entire income tax on the distribution amount in the same year, but you can take it in 3-year timeline. So they are good benefits that the CARES Act provides, because they are aware that many of the taxpayers are getting in through tough times during the COVID scenario. And as I said earlier, you can defer the capital gains. As you can see in the chart, now the line, which is the 20% line, goes way up to 39.6, which is the green one. So whoever is at the current levels, you are going to see huge hike when Biden's laws or rules come into place. So estimate your income as soon as possible. And we really start tax planning sessions with My Tax Filer in July, August each year. And this year we are even talking about starting it in May itself, because that's how important tax planning is compared to the tax filing that comes every year. And going forward, if you don't plan your taxes, then yes, you would end up shedding a lot of money, which you really need not. So additional techniques, please get in touch with us. Again, because of this time that's given to us, we'd not be able to cover much more on this presentation today. Let's move on, Anil. Great. So Legacy Wealth Planners, this is founded again by Sudhir Pai, who's a founder of My Tax Filer as well. He's now a financial planner. He has all of these umbrellas where he's now a financial advisor or a tax reduction specialist, if I have to tell it in the straight way. And he is into wealth management, tax planning, retirement planning. And all of this are very, very important for you to start understanding. If your income level, let's say, is a $300,000 or more, I'm talking about joint return income. Now, you could end up in tax saving strategies where if you invest, let's say, in a $25,000 and you get at least 90% benefit, where you don't need to pay taxes on 22,000 and only on 3,000, let's say you want to pay taxes, you would definitely be happy. So we have good schemes that are available, which helps you with tax reduction. So if you fall into a bigger tax bracket, let's say more than 30%, then these are schemes that you really have to consider. We can get you connected to Sudhir, and you could talk much more on all of these planning techniques. He started very recently, let me say in the last couple of years, and you wouldn't believe that he's already handling a portfolio of more than 100 100 million in the wealth management or the money management cadre. So that's how good it is. And the returns are also really, really good. And clients who has invested basically through his money management services are very happy. So if you want to talk more on that, we can get you an appointment with Sudhir. Let's move on, Anil. And on the wealth planning as well. Now, I was talking about tax saving strategies or the tax reduction strategies. There are other alternative investments as well that is available. This may not end up helping you save tax, but let's say you have a good amount of money in the bank account and you're not even getting any interest, or it's a very small amount of interest. If you're going to move this money to such alternative investments, let's say multifamily apartments, single family home investments, self-storage, and then there are a lot of preferred stocks, private equity, real estate bonds. These give you good returns because the ones that we have tie up with have a lot of track record, and they give you returns. Like the IRR is basically between 8% and even 18%, and sometimes it can be even higher than that. So if you have a lot of idle funds, then this is something you need to look out for. And with the market volatility, now many are skeptical to invest more in stocks. So if you don't want the stock side, and if you want to invest directly in real estate yourself, you may end up getting into losses if you don't know specifically the valuation of that particular area. So that is when these alternative investments, the builders or the promoters basically know everything in that particular area, and they will invest only when they see it is profitable. So if you are having that fund and then trying to invest there, you can help save a lot of money for yourself, and your wealth grows quickly compared to you trying to do everything yourself. So I would urge for clients who have a lot of idle funds to use all of these concepts that Legacy Wealth Planner can provide you. Okay, so that's it with my side. I hope I have covered what is the real crux of this presentation. There are a lot of things which we can't talk because it's a vast one. Plus, we don't want to confuse you and then you don't end up getting any sense of this presentation. So I am good here. Thank you again for this opportunity. I'll hand over again to Anil so that he could leave out the deal of the day. Thank you again.
Thanks, Christy.
Sure.
Okay. So for the listeners here, here's the deal for the day. Say maybe we are here around the clock. Around the year. It's not like something like we help out in the tax season and going out. Like there are many firms that way. We are here, and all the assistance will be provided around the year on the tax returns, whatever filed, as long as whatever documentation provided is clean. So with this, the listeners, like I would like to give the deal of the day, like say 2020 business tax returns filings, like we are offering $450, like one state and filing federal tax returns. And for any individual tax returns or the personal tax returns particularly, say we give a 50% of discount on the actual fee what we charge, with always like we already have in code for the KCOB for Brindavan Association. Like you can always reach out to us and write to New Jersey at MyTaxFiler with the code KCOB 2020, and we'll address and we'll provide the best deal filing your returns. Beyond that, the only agenda of ours would be like file a compliant return with the complete obligations met and have peace of mind, rather than like just filing just with your W2 and becoming a non-compliant taxpayer in case if you're obligated to file some international compliances. So yeah, you can always reach out to us, and this is our address. We have our office on Amboy Avenue. And you can always reach us on 732-455-1504 and write to us at newjersey@mytaxfiler.com. This will be open, and we are open for the questions now. Like we see multiple questions coming in. I would like to answer the questions whatever being posted. So we see a question like, do we get a foreign tax credit for NJ state? Unfortunately, like NJ state do not provide any foreign tax credits paid outside of United States, like unless it's within the foreign states, within United States. They just charge the flat tax rate on the income, whatever the foreign income you report to New Jersey state particularly. Say even other states like say Illinois, they do not, or Pennsylvania, they do not provide any foreign tax credits on the foreign income you report. And we see one more question like, would stocks that gain or loss fall under the same tax bracket for long-term and short-term holding? No. See, short-term particularly, like if you're holding a stock for less than a year and selling it within a year, then it'll obviously attract the regular tax bracket where you fall under. Either it is 22%, 24%, or it might be 32% or 37% tax bracket. It just get added to your regular income, and it's not taxed with the special tax rates. But long-term particularly, like let's say you're less than, like your income is less than like $70,000 and you have some $75,000 and you have small amount of long-term capital gain claim, you basically are not charged anything on the taxes. And to say the max tax bracket you pay on the long-term capital gain will only be 20%, even though if you're under 37% tax bracket, because IRS has given a relief on the long-term capital gains and some qualified dividends what you get. Christy, do you want to take any questions?
Of course. I was just flipping through. Give me 1 minute. I'll pick them.
So, before that, I would like to answer one more. Like, when would I report IRS when we sell a property in India, or bank interest when, and what's the dollar to limit? What's the dollar limit need to be reported? So usually you'll have to report, in any of the transactions, any sale transaction happened, either it might be a property or in a stock or any fund you sell. the transaction will be reported in the year it happens. Like say you sold a property in 2020. Yes, you'll have to report that in your 2020 US tax returns. And there is no limitation whether it is a loss or gain. Yes, you still have to report. That's an obligation as a resident. And there's also no limitation to dollars saying, let's say if it's less than $10, nothing as such. Every dollar is treated as an income what you make or the gain what you make, and everything is to be reported.
Anil, this is Sarayu here. I want to add the same question what you are asking about this selling a property in India. So like once somebody sells the property and then they want to bring the repatriate the money over here, is the procedure like what is the timeline? How long it's going to take? Can they bring it immediately, or it takes some more time for them?
See, it's all about, like, let's say, let me give you an example. Say, for example, a taxpayer has sold a property back in India, right?
Okay.
And he has made some good amount of capital gain on it, even though considering the indexation concept what we have in India. Let's assume, like, say, there are, possibilities where no need of waiting till you file the tax. See, the concept is like, unless you pay taxes in India, the bankers are not going to allow you to move the funds outside of country. They expect, the banker will expect a document and self-declared document and a certified document by chartered accountant saying there are forms called 15CA, 15CB. That has to be certified saying, okay, these funds are all post-tax money and it is ready to move. If you when answer to your question, like once the taxes are paid on the gain, whatever realized in India to Indian government, yes, you're happy to move that money back to US, and there is no timeline. Like once you report everything, and if the banker is ready and the taxes have been deducted upfront, you can go ahead and move that money.
Okay, thank you. And some of them, I don't know whether you checked the chat, and then some of them asking about the estimated taxes. You explained really well with both of you.
Yeah, I see that question. So what does that mean? Their charge. I see a question like, what would be the range of penalties, charges if they paid the
correct,
not paid within due date? So see, estimated taxes, like usually 5% of penalty is charged, and it's something like every quarter has a different deadline, right? So we'll have to calculate, the penalties from the due date of every quarter. Okay, it's a bit complicated, but yes, 5% of penalty is usually charged on the unpaid taxes, and accumulation of interest keep happening. So that's the reason we urge like every person to pay it upfront. And also I see a question like, where is there a way I can go ahead and pay it in installment basis to IRS? Right? Yes, correct. You're always welcome. Like if you have a clean record and you can always file for an installment agreement with IRS, you can pay. Based on your monthly payment options, what you opt, they decide what's the penalty or what's the interest that will be additionally, not the penalty particularly, the interest will be interest will just keep accumulating based on the installment amount you opt to pay every month to IRS.
Okay.
And also, I see.
And also 401k, have you checked your check?
Yeah, I'll answer there.
Okay.
Okay. So the question there was, if I borrowed from 401k as part of COVID Relief Act, what is the policy to pay it back? Could I pay it back in the first year or any time in 3 years? What is the taxation policy? So as I told earlier, 401k distributions, many clients ended up taking because they had a lot of reduced work hours, or they lost their jobs, etc. So they had to literally use up their 401k. Up to $100,000 is the amount you were allowed to withdraw and also be safe by using the COVID CARES Act. Not everyone are allowed. Now you should have reduced work hours. There should be some financial consequences because of this COVID era, or you have somebody in your family who were infected and you ended up having to quarantine, or you ended up spending a lot of money on the medical side. So there are like 5 to 6 conditions that the IRS has put up. So only if you follow or rather have one of it, you will be able to take this COVID CARES Act. Now, this is how it works. Let's say you end up falling into one of the condition that the IRS has put up to 100,000, you will not have to really pay early distribution tax of 10%. If you don't reach the retirement age and you take any money, this 10% additionally was levied apart from the income tax. So that would be taken away. That's one good thing. The next thing is, let's say income tax is definitely there. So that's the crux here. Because there is income tax on 100,000 distribution, let's say you fall at a 20% bracket, you'd still have to pay 20,000 and you don't have such kind of money. So what you could do is split this 100,000 to 3 years and pay 1/3 each year, instead of paying everything with your 2020 tax return. So that is the difference compared to the earlier years that this COVID CARES Act has brought up. And I have one more question where it said we opened a trading account last year and have been receiving dividends. Where do I report this? So it's exactly how you report your US dividends. This gets into something called Schedule B, and you will have to pay tax to the US. And most of the time in India, these US dividends don't get taxed. I mean, the India dividends don't get taxed. So if you have not paid taxes in India, unfortunately, to the US, you end up paying tax. But let's say you ended up paying tax in India, you can take that as a credit in the US to avoid double taxation.
Okay, I see one more question coming
yeah.
out. What is the implication or limitations on filing FBAR? What are the limits of bank balance maintained in the bank in India that should be reported? So it's not an implication limitation, like it's basically it's an obligation for every resident to report an FBAR. As I said, yes, if you're having a balance of more than $10,000 sitting in your foreign financial account, either it might be one account or it's an aggregate of all the foreign financial accounts, you have to report all the foreign financial accounts except the real assets. So real assets, you don't have reporting anything on FBAR. Rather, if there is any rental income, you report it on the tax returns. And when we talk about FBAR, when the statement says foreign bank account reporting, it talks about foreign bank account reporting, but it's not limited only to bank. It includes all your foreign financial accounts. Like it might be PPF, PF, life insurance, mutual fund, DMAT, LIC, post office account, fixed deposit, bank accounts. All these are covered on your foreign FBAR concept.
There is one more question on 401k only. That is, they are saying somebody opened like a traditional IRA, and I think then they moved to Roth IRA in 2020. They are asking the conversion usually is taxed at the current income bracket. They want to know.
Yes.
Okay.
Yeah, go ahead.
Yeah. Correct. So traditional is basically like a pre-tax, just like a 401k. So if you convert it into a Roth, there is, if it's a straight conversion, right, you end up having to pay taxes at the normal rates, just like how your other income is taxed. And when you finally take it from Roth, the distributions are not taxed. So that is basically the concept why someone will move money from traditional to Roth. But there are another category of taxpayers where they can't really directly contribute to Roth because the income level is above a certain limit. So they open something called a backdoor IRA where they contribute to traditional and move their money to Roth. So these kind of transactions would only incur tax on the growth, if any, until they convert the money. So if you're not talking about backdoor, then yes, you will have to pay tax and at the normal tax rate, just like how your other income is taxed.
I think maybe we are
we'll running out of time.
Maybe the last question, Anil, it's actually from me. You are talking about it was a very useful information you guys gave, but regarding the stimulus check, the second stimulus check,
okay.
I think everyone wants to know, like now 2020, most of us has not filed the taxes. So will it be like they take the 2019 taxes one, the tax returns income, and the second one, whoever have received in 2020 stimulus check, they has to report in their 1040 filing?
Okay, good question. So firstly, answer to your first question. Say if the taxpayer has not filed their 2020 taxes, SBI finalizes or the Congress finalizes saying the money is being sent out, the third stimulus is approved. Yes, they just go basically on the 2019 tax returns, whatever they have, whatever the latest copy of tax returns they have. And there are, as I mentioned, like in our earlier discussion too, like we'll just have to plan, like if in case if there is increase in income in 2020, people are just waiting to holding it on just for the stimulus pay, because it's all because everyone are hit by crisis, COVID, right? Like, and really, majority, few might be really doing good in the market, like market is literally crazy, and we see that. But yes, the answer to your question, they just go basically on the latest tax returns. And adding to this, very good info, released by IRS is, say if the kid was born in 2020 and you might have not received the stimulus pay for the kid born in 2020, you can claim the stimulus pay in the year 2020 tax returns because the kid was not present on 2019 tax returns. You will be eligible to get the $500 of credit for the initial round, and also $600 from the second round. $1,100 will be given for a kid born in 2020, provided you have the income limits. Your income is less than the limits whatever is provided by IRS. And one more adding concept here is, say if you're eligible to get an SSN and you don't have an SSN now, you can apply it, file an extension, and you can claim the stimulus pay till 15th of October 2021. That is still the extended due date. People can still go ahead and enjoy this money. And second question, saying, is it taxable? No, it's not taxable. No stimulus pay is added on your tax returns and nothing being taxable. It's all money given out during this crisis, during this particular pandemic or the bad time what people are going now.
Okay, thank you. I think all the questions you have answered so well, and thank you so much, Christy and Anil. And then now go from. I will move on over to Padmini.
Okay, yeah, thanks everyone, all the listeners, and yeah, I've been with KCOB for almost 4 years now, and yeah, we have good rapport as a family. Yes, I'm ready to contribute. I'm ready to help, and yeah, please feel free to get in touch with us for any of your tax filing needs or any international compliances. Thanks for all your time.
Anil and thank you so much. This was such an informative session. I'm sure all our viewers much appreciate the two of you taking time out, and this very apt timing also, right? We are all ready to file our taxes, and we had so many questions, and you've covered everything end to end, from a new immigrant's perspective to business owners, FBAR and educational credit, stimulus packages, even the recovery rebates and businesses, and what estate taxes would look like. I think we could have easily gone another 1 hour and we would still have so many questions with all our viewers, and within me, I have so many questions myself. And Anil avre, neevu yavaglu Brindavan jote, you've been such a patron for the Brindavana team of people. We really appreciate you taking time and introducing us to Christy. Christy, it's midnight, beyond midnight for you. I'm really, I don't know how to thank you, for staying up so late and helping our viewers understand some very complex tax terms, which are otherwise not easy, There's too much of information when we try to Google or when we try to get onto YouTube and look at any of that. And our very apt moderator, who's our in-house accountant, Sarayu, thank you to you as well. And the wonderful
thank you, Padmini.
Behind this, this was a seamless, wonderful webinar. I want to thank Anil. I want to thank Christy once again, and all the team that's working behind this webinar. Facebook Live, YouTube Live teams, thank you, and thank you to all the viewers as well. So we'll see you back soon again. Thanks, Anil. Thank you, Christy.
Thanks, Padmini,
Thank you.
and thanks for all the organizers for getting this successful, and for all the efforts being put.
Yes.
Thank you.
Yes. Thank you.